All right, so we're recording. I'd like to welcome everyone to the first Wednesday webinar of 2018, talking about farm financial statements, which is really timely for this time of year. Upcoming, I think we have webinars scheduled through the midsummer. Next will be What is Urban Ag, Divorce and Farming. We also have the 2018 Mid-Atlantic Women in Agriculture Conference coming up next month. Registration's still open for that. And we also have the 2018 Annie's Project classes announced. So lots going on this time of year for Mid-Atlantic Women in Agriculture. Here in the blue link, Wednesday webinars, you can find upcoming events as well as our past recordings on this website, extension.uni.edu/women-in-ag. Would like to thank our sponsors for the program. They sponsor the Women in Ag program today, as well as the collaborators for this project. So going ahead and getting started with farm financial statements. Going to talk a little bit about financial documents, the three financial documents that we use in farming, as well as enterprise budgeting, and then just wrap up the webinar by talking about tracking costs and expenses and some of that record keeping tips. So this is pulled from the business planning workbook. It's part of the financial planning section. And the three statements that we want to discuss today is the balance sheet, the income statement, and the cash flow statement. So these three documents are very different. They show different financial aspects of the farm, extremely important when you're looking at the overall health of the farm, making major decisions on the farm, or talking and working with a lender. So starting off first, again, important and necessary component, balance sheet shows solvency, kind of that net worth piece. Income statement is profitability, and cash flow can show liquidity. So while each one of those shows different types of financial statements, they show there's a different reason behind each one of them. And then we call those that are planning on or making projections, those are pro forma statements. So those are projection statements. Projected financial statements are extremely important for lenders or farm operations, or other factors may require some type of projections. And that's if you want to say you're looking at maybe a line of credit, or you're looking at investing in poultry houses or a greenhouse. They're going to want to see some projections. That's where really having some good background documents and some good background data, and then being able to make good estimates moving forward. And to do this, reviewing enterprise budgets and your financial statements, which we'll be talking about today. So to get started with, balance sheet is the one that shows net worth. And it's the one when I get my line of credit, or I call and talk to the bank, send me a current balance sheet. That's what they ask for. You guys may have heard that before from your bank. What it summarizes is your assets and liabilities. So it shows everything that you own, evaluation of what you own, and then what your debt is. And they figure out the net worth by taking the value of your assets minus the value of your liabilities to get that net worth. On a balance sheet, they're often divided into three categories, or possibly four categories. Is your current, so what's due this year, so it's less than 12 months. Your intermediate, which is 1 to 10 years, or 2 to 10 years, which you're looking at some types of machinery, maybe vehicles, that type of thing. And then your long-term, which is more than 10 years. And those are things like mortgages, longer-term equipment or land payments. And then often there is that non-farm piece. So you have kind of the farm business, and then you have the personal. So often there's a non-farm piece in there. I've seen people have kind of two balance sheets, kind of their personal balance sheet and then the business balance sheet, and they're able to use those, have a non-farm section on the balance sheet to show their personal piece. Off-farm jobs, spousal income, sometimes those are important. So really, a balance sheet is a snapshot of the business's financial position, and that's a certain period of time or a certain time frame. So if I complete the balance sheet today, I put that date on it, I save it as that date. If I complete it next month, it changes, right? Because I've paid down another month's worth of debt. So again, it's that snapshot in time. So a balance sheet's always dated. Looking at, this is kind of when they talk about the left and the right-hand side. So you have your assets. That's your cash available, savings, checking, accounts receivable. So what's coming into you, what's owed to you. Maybe what your inventory is. So those are your assets. You could sell those to have income. Your automobiles, your ownership of machinery, equipment, and property. Often things that are leased or that you don't physically own, they would not be listed in the assets category. They would be listed elsewhere on other financial statements. For liabilities, you have your accounts payable, so anyone that owes you money that you're expecting to come in, credit card debt, notes payable, mortgages, other types of loans. And to do the calculation, it's assets minus liabilities equals net worth. And the net worth is where lenders would make decisions on whether, how much they could loan you and what your lending abilities are. Balance sheet tips, save the balance sheet by date and complete it at the same time each year if you want to start making comparisons. So a December 31st balance sheet is often what many people will do at the end of the year. They'll do a balance sheet December 31st to look at that year's, that snapshot, and then compare over years. Another tip for a balance sheet, and this is where it's difficult. I know, when I've completed mine for my line of credit, finding the current market values and making sure that you're realistic with those, and we know market values go up and down. There's a lot of information online about how to make those determinations. If you have appraisals, that's great. Kelley Blue Book, if you can pull up things like that, is really helpful. You can look cost basis or market basis. So there's two kind of ways of doing it. For cost basis, you're looking at taking out what the cost of it was minus depreciation. For market basis, you're kind of looking at what that market is. So something like grain and livestock, you would value based on the market. All right, so that's a snapshot of the balance sheet. The next is the income statement, and that shows profitability. This is a summary of revenues and expenses for a specific time period. It shows your income, which is receipts from sales, government payments, dividends, that type of thing. Expenses are your production expenses, interest, taxes, insurance, loans. So it's your income coming in, your expenses going out. It is different than a cash flow statement because of the adjustment section. So the income statement shows a true snapshot of profitability because in an income or a cash flow statement, which we'll talk about next, you're not making these adjustments. So for an income statement, you will adjust your inventory values. So if you're holding grain, if you're, say, a value-added producer and you've got something that you have on the shelf that you haven't sold yet. It also takes in account accounts receivable. So if you have, if you're waiting on a poultry check or you haven't received a check from a restaurant yet, those adjustments are made on the income statement, which makes it different than a cash flow, as well as that depreciation and capital adjustments. So there's some very big differences between the income statement and the cash flow statement to show that true snapshot of profitability. To be able to calculate it, you take income minus expenses and you get your net income. And the main purpose is to determine how much income was generated by the farm operation. So here's just an example of what you would find in the categories. The income would be sales, government payments, accounts receivable, grain, livestock inventory. So if you have those sitting somewhere and they have a value to them, salary, wages, interest, dividends, rentals, other income. Expenses would be your production expenses, auto expenses, accounts payable, taxes due, labor, equipment, repairs, maintenance, fuel, and insurance. So those are types of categories that would come up on the income statement. To calculate that, you would take the income minus expenses, but you do an additional calculation to adjust for your inventory and depreciation, and that will give you your net income or profitability for the year. Some income statement tips. So an income statement is also often called the P&L or the profit and loss statement. This statement is the one that most closely tied with your farm taxes and the way that taxes are. What I would recommend, and when people start talking about keeping records, the Schedule F, I would recommend going to the IRS website that's here in blue and download a copy of the Schedule F. There's also on this link Schedule F instructions. So it gives you a lot of information about what each of these categories would include. And then there is a lovely, I don't know, maybe publication 225 means how many pages. It's probably about 200 pages, the Farmer's Tax Guide. And I would definitely take some time to review those each year. There are definitely changes every year. Of course, you'll be working with an accountant, talking with an accountant, but this is a great way to help organize the way that your expenses are and alleviate some of the time at the end of the year in pulling your taxes together. So the Schedule F, your Schedule F instructions, and then the publication 225 Farmer's Tax Guide are really, really helpful. The cash flow statement includes liquidity. It summarizes all cash inflows and outflows for a period of time, weekly, monthly, quarterly, or yearly. So you can decide, some people want to know weekly cash inflows and outflows. Some, it may just be more of a monthly question, and some will extend it to quarterly. And then you can also then pull in a yearly. So across the top, you would decide on a period of time that you would have. Cash flow is your checkbook accounting, so it really is what goes through your checkbook, what goes through your bank statements, the inflows and the outflows. This is extremely important because of seasonality. It does help you plan your income and expenses over the year. And again, compared to the income statement, it doesn't take into account kind of that inventory or depreciation that you would be including in an income statement to show true profitability. This is just if you're able to make your payments, what comes in and what goes out. For cash flow, we talk about really two statements. You have a projected cash flow to say, looking forward, this is what I think is going to happen. And then at the end of the year, you have an actual cash flow. So right now, January 10th, I would do an actual cash flow for 2017. So what were my inflows, what were my outflows? And then I would sit down, and as I'm planning for my 2018 growing season, I would make projections going forward with what I think is going to go, is how I think 2018 the inflows and outflows will be. This gets better as your operation continues, as your record keeping gets better or more accurate. You can make much better projections, and those are very helpful when you're making big decisions, whether it's land purchase, expansion, hiring. Maybe you want to hire someone, maybe you want to quit an off-farm job and come to the farm full-time. Having more accurate numbers in the long run will be very important and helpful. So cash flow statement, your inflows, again, much like the income statement, your product sales, those receipts, any sale of capital assets. So if you sell equipment, if you, most often it's equipment that you would be, that you may have that you sell. Maybe it's custom work that you do that you get paid for. and borrowed money. So if you get a line of credit that you draw from. Your outflows would be production expenses, so seed, fertilizer, feeds, things that it takes to grow. Your capital expenditures, so that's your utilities, your fuel, repairs, taxes, and rent. Also includes your loan payments and then living expenses. Often on a cash flow statement, you'll have like an owner's draw or something that you'll use for your living expenses. I've also seen on cash flow statements off-farm income included. Sometimes, especially when you're getting started, that's the only way to make the net income positive. So you could include off-farm income in the inflows as well. That calculation is income minus expenses, gives you net income. Some tips for the cash flow statement. Decide on the increments you want to track. So again, whether you want to do this on a monthly basis, bi-weekly basis, quarterly basis, and then look at the categories of income and expenses that you need. Haven't mentioned it yet, but there's a ton of templates online. Anyone that's working in Excel, I've seen a number of record-keeping books where you can just, you can print them off and do it by hand. Any of the ways that works best for you to put these documents together is extremely helpful. So you can decide on the categories of income and expenses that you need, and say you're all crop, well, you download a cash flow statement. It may have feed or livestock expenses on there. You can remove that and customize it for you. It will show when the cash is coming into or leaving a farm and when you may need an operating loan. So that's really helpful, especially the seasonality of farming, or maybe you're planting one year and you're not going to have a harvest for 2 or 3 years, depending on grapes. It could be grapes or livestock. Sometimes that's pushed out. It'll help you to know when to schedule loan payments or to make capital purchases. And again, a projected at the beginning of the year and an actual at the end of the year, and making those comparisons is really helpful. One thing I wanted to say about cash flow and really modifying it so you understand really where expenses are and how exact that you want to be. You can break those down into, so you have a farm cash flow statement, but say you have multiple enterprises within it. You could break it up by spring, summer, and fall crops. You could break it up by, say, the greenhouse and the outdoor. Maybe it's grain and poultry. So, I've seen a lot of cash flow statements where product sales won't be just one lump sum, but it would be product sales, and then a subcategory underneath that would be poultry revenue, or, farmers market revenue maybe. It can be divided so many ways. I think it's just really important to decide how, what are you trying to measure, and then if it matches with the outflows. So something like greenhouse sales, you could then pull out the production expenses associated with the greenhouse, pull out capital expenditures with the greenhouse. Maybe it's a livestock and a crop enterprise. You could split those out however much you want. It takes some more record keeping, but that really helps to decide within a farm what enterprises are doing well and what maybe aren't doing so well. That kind of takes me to the enterprise budget. Sometimes I start with these slides. Today I'm finishing with these slides, but I'm a big proponent of enterprise budgets. I think it's helpful to look at your crops that you're growing, and understanding the variable costs, the fixed costs, and the income related to each one of those. So an enterprise budget is an organized listing of your estimated gross income and costs for a particular enterprise. So it could be hay, it could be cut flowers. It divides the costs and returns for each of those, and it really does help determine the productivity of an enterprise and whether it's something that you need to continue or to change or to modify, whether it's beneficial to your farm. Enterprise budgets are on a per unit basis, so sometimes I've seen them often in a per acre, or you could go down to per bushel, a ton, a per square foot, per 100 square foot, per hundredweight, per head, any way that you want to divide that out into a unit. And then you can start doing some calculations. This is very helpful to do a cash flow statement. So we've done a number of case studies, and the only way to get, say, our seed costs is to put together these enterprise budgets, and then we can add up our seed costs for each of the enterprises. So that's a great way to be able to complete your enterprise budget and to then move to the cash flow statement and to do a projected cash flow statement. So on the enterprise budget, it's divided a little bit differently. You do have your income, and then you have two types of costs. One is your variable costs, and these are expenses that vary with output within a production period. So an example would be the more animals you have, the more feed you need. The more land you have or crops you're growing, the more seed that you need. So they vary with the level of output that you need. Fixed costs are expenses that don't vary. So you owe these whether you're growing, all 5 acres or just 1 acre. Your building costs, your machinery, your taxes, your insurance, and your mortgage. So those are separated. Most often when people are getting started, they're looking at just covering their variable costs, making sure that they can break even or cash flow that crop, and then they look into covering the fixed costs. So to get net income from an enterprise budget, you take revenue minus variable costs minus fixed costs, and that gives net income. Again, it helps you determine your expected income, whether you're covering your variable costs. So if it costs me, say I'm growing asparagus, am I at least covering the amount of seed, fuel, and a lot of people don't include labor, but labor that it takes to grow that. And then you can look at income over variable and fixed costs and then make a decision based on that enterprise. Just a little bit more about enterprise budgets and pulling those together. You should be prepared with specific objectives. So I think income many times, especially if you're looking at direct marketing, how are you going to be selling those, what units, and what markets are available, and how you'll be pricing that. Cost for establishment of crops, soil types, and the management of them. Receipts and costs can be sometimes difficult to estimate, and again, as you do projected and actual, you'll get better and better, and the records will get better and better to be more exact. Make sure that you contain receipts for every product and byproduct, and that prices should reflect market values and the productivity of enterprise resources. So there's some ways to make some estimations out there. I think Ag Marketing Service, ERS, they publish a lot of the wholesale markets. You can look locally at what is being sold. MDA has that available from some of the farmers markets. So trying to get an idea of your prices is helpful. So that's really all as far as the financial statements and enterprise budgets. Again, there's many resources available online, templates to help get you started, an easy search for enterprise budget with, I usually do extension enterprise budget and then whatever crop I'm looking into. And there's lots of templates out there available to help start creating these budgets and knowing what the costs are associated with the crops, so then you can complete the cash flow statement and do some projections. So going to talk and wrap today up by looking at resource inventory. These are just some other record-keeping things to help with. Having these will help complete the balance sheet. It will help work with your insurance agent. So a resource inventory gathers resources, physical, or an expertise maybe that's very important to your farm. Listed here that I'm going to briefly talk about is building and facility requirements, building and structure inventory, and then an equipment inventory. And again, having a sheet of those and knowing the value of those and assigning a value and having the specifics of them can help for many different reasons. Your accountant, your insurance agent, and of course filling out your balance sheet. So building and facility requirements, these are physical resources that you have. What land do you own? What are you leasing? Your livestock, your equipment, your facilities, your transportation, and then what expertise do you have there? Do you have access to? And that can help you look as you're moving forward and your farm's expanding. As far as there's a lot of people that may say, I'm not great at marketing. I want to sub some of that out. Payroll. I don't want to deal with payroll. It takes a lot every week to do that, or every other week. So they're going to sub that out. So what expertise do you have internally, and what might you need externally? So building and structure inventory. This would be a spreadsheet or a document that has it listed each building, their purpose, their square footage, any special features, and then the location of that building and structure. The next would be an equipment inventory. The equipment name, the model, the size, year purchased, age, condition, ownership, maybe what you purchased, the purchase price, the book value, the market value. Again, this is valuable information for your financial statements. It also can be used in many, many other ways. You can add VIN number to this, tag number, all of those type of things to keep a good spreadsheet of what's owned. And then wrapping up, just looking at record keeping and tracking enterprise costs. It's important to understand the cost of each enterprise, and there's a lot of record keeping software that's out there. And an example, this is an old screenshot of QuickBooks Pro. It's one of the classes that we do here locally to talk about financial record keeping. And as you get better, you work with an accountant to get depreciation and equipment added. You can add payroll. It actually will run reports for you on these financial statements, and it can even categorize it by enterprise, depending on the how in depth that you want to get or that you need to be. But it will run your profit and loss reports. It'll run a balance sheet. It'll run your cash flow statement, and it's a great way to organize. They do have a farming and ranching chart of accounts. So when you set up QuickBooks, you can say, I want to set up a chart of accounts, and it will give you that information. This is an example of it. And again, you can create subcategories, and it may be hard to see, but an example here is we have insurance. We've separated that out by crop insurance, disability insurance, liability insurance. You can do sales. You can pull sales out, and you can do it by enterprise, or however keeping those records is helpful to you. Of course, you can write checks using your QuickBooks, and it keeps your vendors, it keeps many things organized. You can keep invoices, accounts payable, accounts receivable, all on that software. FarmDoc is another great one, especially if you're working with grain, to look at different spreadsheets, decision-making tools, and ways to set those up. And this is just some of the FAST tools. So they've got enterprise allocation, farmland lease analysis, machinery economics. Again, this mostly works best for grain and corn and soybeans. Lastly, these are some of the resources that I've used. Lots of templates out there, and help in putting them together. You can download them and then modify them how you need. Two real things you want to think of is, number one, what information do you need, and how much time you can keep records on anything there on the farm, but what do you really need to make decisions on? And time ends up being often the limiting factor. So ways to make it much easier to keep your records, um, however that may be. Here's some of the other resources that we have. My contact information. We will be posting this as well as the slides on the webinar website. So with that, I'll take any questions.